name is Karisma Wong and my student ID is PBS2302. Our unit title is Accounting Theory and Current Issues. Today we are going to do a 10-minute video presentation where each of us will be talking about each section shortly. So we will be talking about the adaptation of IFRS in between Australia and New Zealand. So I will be talking about the first question, which is the positive accounting theory and the relevance that is in regard to the financial reporting system. So I would like to explain what is positive accounting theory first. So positive accounting theory tries to make good prediction of real world events and translate them into accounting transactions. So the overall intention is to understand and predict the choice of accounting policies across different forms. Similarly, financial reporting is designed to provide you with effective reporting, technical accounting and business skills, and also values that are applicable in global environment. Overall, positive accounting theory is concerned in making prediction which helps in reconcile the efficient security market theory with economic consequences. So basically there are three types of hypotheses, that is bonus plan, debt equity hypothesis and political cost hypothesis. So what is bonus plan hypothesis? Bonus plan hypothesis, the firms increase the income of current period by applying the accounting methods, and in debt equity hypothesis it states that the firms with a higher debt to equity ratio apply the accounting procedures for the transfer of income from future periods. Similarly, political cost states that the application of accounting procedures by the firms. So basically, positive researchers empirically test their predictions around all these types of hypotheses that is mentioned above. So I would like to relate it with one of the example in which says that if a firm had a remarkable financial year, it can be predicted the next year can be a year of financial stability to boost the dividend payment to the investor. So that was all about the relevance of positive accounting theory in regard to financial reporting, and the next questions will be covered by my friends individually. Thank you so much.
Hi, my name is Pravas Bora and my student ID is EMV24731, and I'm talking about the second part of the question. So let's start with the background of the question, the New Zealand adaptation of IFRS. The decision of Australia to adopt IFRS in 3rd of July 2002 was a catalyst for New Zealand to adopt IFRS. So the New Zealand financial body ASRB decided to adopt IFRS in New Zealand by Jan 2007. So now let's talk about the regions of New Zealand adopting IFRS. The first one is to show the New Zealand's commitment to adopt IFRS, to show the New Zealand commitment to follow the single set of accounting rules throughout the world. The second one, adoption of IFRS would help in free flow of capital in New Zealand. And there are many other reasons for New Zealand to adopt IFRS, which are explained briefly in the assignment. Now let's go about the issues faced while adopting IFRS. It resulted in copying a lot of action from other and delayed in decision making because of lack of knowledge about IFRS standards. The second one is capturing the data and presentation was a difficult task while adopting IFRS. Another important one is it increased the cost of entities. Like there was a cost increased, such as they had to hire accountant audit for IFRS. Now let's talk about the challenges faced by entities while adopting IFRS. There were many challenges faced by entities. Well, I will explain few important ones. The accounting treatment for goodwill amortization was treated differently before and was treated differently. Well, after adopting IFRS, the treatment for these accounting were treated differently. And another important issue we can discuss is about the cash flow statement. IFRS standard states that cash flow statement should be treated by the direct method. Well, the entities used to follow other.
Hello, my name is Rakibul Haq and my student ID is FIR2875, and I am going to start my part. The first question is the advantage and the disadvantage of IFRS compliance. Some certain advantages of IFRS compliance include: 1. Expanded inventory reporting and tax planning. 2. Improved daily operations. 3. Highly managed resources. 4. Multiplied monetary countries. And 5. Low cost of capital. And the second thing is, my question is the difference between similarities and dissimilarities of Australia and New Zealand comparison. And when I found some differences and similarities between Australia and New Zealand, New Zealand and Australia have an agreement to adopt IFRS. The only point of contain that maybe New Zealand may be the first country of the adopt IFRS. Australia is divided on a subject. The most important statutory government, the establishment of accounting assistant in the New Zealand in the Monetary Reporting Act 1993 FRA. This is my part finished, and I call my friend to continue the part. Thank you.
Hello, my name is Preeti Kafle and my student ID is OLI 2880. My part is adoption of IFRS and its comparison in two countries, Australia and New Zealand. Was it successful or not? First of all, when IFRS was already introduced in Australia, New Zealand had to follow IFRS, and it had many difficulties in early days because European Union had much broader varieties and Australia was also following. When AASB adopted IFRS in 2005, there was harmonization before the FRC announcement, which alternatively leads to formation of a Big Bang approach, which caused Australia to be influenced under European Union. This result caused Australia and New Zealand both to have monetary shortage in economy. After adaptation of IFRS, it was a rigid market because not much information was supplied and they had difficulties in operation. Small scale and medium sized entities were having trouble, so today they deferred the proposal and only adopt general purpose financial statement. So next one is, according to FRC and AASB, IFRS had a positive impact on Australian economy. It is because public companies and investors were doing really well compared to rest of the investors around the world, and it has a positive influence. While compared to New Zealand, it had a gap in New Zealand, and IFRS was not really significant. From the overall feedback from previous study and previous question, Australia is positively influenced by adaptation of IFRS in economy. It might be challenging in the beginning, but in long term, with the implementation and modification of the standards, it seems advantageous. And for New Zealand, they are not so much positively influenced by IFRS and the cost of equity capital. Thank you.
Good afternoon. My name is Ranita Kesi. My student ID is EMV 24725. We are in the last section of video presentation, and I'm going to speak on question number 4 shortly. So in question number 4, we are going to recommend Australia and New Zealand to ensure how IFRS is relevant to all economic sector. So for Australia, first, Australia needs to improve audit consistency and enforcement, because we know these things enhance the quality of report, which increase the value of company in the capital market. Due to which we know investors are more likely to invest in the company which have fair and transparent accounting compiled with IFRS standard. Second, Australia needs grassroots improvement in education in accounting, because it focuses more on accounting standards rather than IFRS standard. Australian education curriculum needs to adjust more depth knowledge on IFRS.
Start.
Now recommendation for New Zealand. First, it needs to adopt single set of accounting standards which reduce the complexity. Second, the use of general rules and IFRS standards create differences information to be provided within financial report. So New Zealand should follow proper legal implication to fill the gap of normal standard and IFRS standard. So overall, although most of the countries have moved to IFRS standard, adopting IFRS standard, top priority concern for all is to unify the accounting at a global level. So here we end our presentation. Thank you.